last few weeks, we've talked about concentration in markets, inflation, disinflation, and how economic phases shape behavior. Today, we're going to bring those ideas together because when markets feel unstable, people look for protection. When economic signals feel mixed, people want certainty. And when financial goals feel far away, people stop focusing on their daily decisions. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist, and I own Diamond Point Financial. The purpose of Pointe Perspective is to break down complex financial topics into something clear, practical, and manageable. We're unpacking markets, economics, and financial planning strategies week over week so you can move forward in your financial life with clarity and intention. In this week's discussion, we're going to do three things. First, we'll talk about safe haven investing, specifically gold, and why it attracts attention when uncertainty rises. Second, we'll take a closer look at the economic cycle, not just the textbook phases, but how they actually behave in real world. And third, we'll bring this back to your own financial decisions, how understanding trade-offs and timing can help you make smarter choices inside the environment we're operating in. Because fear, opportunity, and discipline do not exist separately. They all live within the same system. Every time markets get nervous, gold gets popular. When volatility rises, headlines intensify, and uncertainty can creep in. People instinctively look for something that feels stable, something tangible, something that doesn't feel tied to corporate earnings or economic reports. Gold has historically carried that psychological weight. People tend to like it because it's been used as money for centuries, it's physical, it has limited supply, and in uncertain moments, that can all feel comforting. But comfort and structure are not always the same thing. Safe doesn't mean immune. When people refer to gold as a safe haven, what they really mean is that it often behaves differently than stocks during periods of stress. That doesn't mean it doesn't fluctuate. That doesn't mean it can't decline. That simply means that the drivers are different. Stocks respond to earnings, growth, and expectations, while gold often responds to fear, currency shifts, and inflation concerns. It's a different tool, but it's not a magical one. You're not just holding bars in a vault. You are still holding exposure. Now, there are different ways that people can own gold. Some buy physical bullion or coins. Some use custodial storage services. And many own exposure through financial instruments that track the price of gold. And those are not the same thing. Like any investments, there are trade-offs. Physical possessions carry storage and liquidity considerations, while financial exposure offers convenience and liquidity. So in most cases, your escape plan is still in the system. If you were to invest through an exchange-traded fund or a mutual fund, that's financial exposure to gold through the market. It's still traded on brokerage platforms, it's still cleared and settled within the financial system, and still dependent on market infrastructure. The trade-off is having liquidity when you need it. This version is often used more as diversification in a portfolio, but that doesn't make it bad, it just makes it realistic. Now, if you own physical gold, there are two primary ways to hold it. You can pay for custodial vault storage with a professional depository, meaning you own the bars or the coins, but they are held at a high security location and you pay a fee for their storage and insurance. Now, if someone's thesis for holding it is total systemic collapse, access becomes the real issue, not ownership. Access is still dependent on a system that would likely no longer exist. Or to fix that, you could hold it personally at home in your own safe or vault. You do have direct access, but there are other factors to consider, with space, security, and liquidity being the major ones. And let's think through this calmly and realistically. If the entire financial system were to collapse, what truly determines value? Who gets to decide? And do we truly believe that gold would be prioritized over food, shelter, or protection? This is why perspective becomes critical. It's fine to own gold, just don't misunderstand it. Gold can be part of a diversified portfolio. It can behave differently during certain economic phases, and it can serve as a hedge against specific risks. But like other investments we've discussed, it's a tool. It's not a replacement for structure, and it is not a substitute for diversification. When people rush toward one asset out of fear, that tells you more about sentiment than structure. Understanding why gold moves and when can be far more powerful than reacting to it or even owning it. Now, economies don't move in straight lines. As people, we like clean transitions. Expansion, then peak, then contraction, then trough. It sounds orderly and predictable, and it makes us feel good. But real economies rarely shift that cleanly. They tend to overlap, they stall, they send mixed signals, and that's where interpretation becomes important. An economic cycle is a framework, not a schedule. Traditionally, we describe 4 phases: expansion, peak, contraction, trough. Each phase has identifiable characteristics. So in expansion, you typically see rising employment, increasing consumer spending, business investments picking up, earnings growth improving, credit tends to flow more easily, and consumer confidence is high. In the peak, the economy is still growing, but you start to see inflation pressures, tighter labor markets, elevated asset prices, and central banks tightening policy. Growth becomes less efficient and excess starts to build. In contraction, you'll often see slowing GDP, declining business investment, rising layoffs, credit tightening. You'll see consumer demand softens and the appetite for risk starts to decline. And then in the trough, conditions stabilize. Layoffs slow down, inventory levels normalize, and policy becomes more accommodating. You really start to see those early signs of recovery begin. Now, this particular phase doesn't usually feel good, but it's often where we start to lay the foundation for the next expansion. Keep in mind, we don't always transition cleanly from one phase to the next. You can see contraction-like signals in manufacturing while consumer spending remains strong. You can see inflation cooling while employment stays firm. And you can often see markets pricing in a slowdown far before economic data actually confirms it. Modern economies are influenced by global trade, policy shifts, and technological change, which means these phases can overlap before direction really becomes clear. This overlap is not dysfunction, it's often just an adjustment. So how much time does it typically take to move through a full economic cycle? Or if you want to get straight to the point, everyone usually wants to know how long until our next recession. And this is an important question because it can allow you to adjust your expectations and your own financial planning. So typically a full cycle runs about 5 to 7 years, but that is not definitive. Some phases last much longer, other phases are compressed by major events. So for example, we saw a recession in 2020, but before then, it had been over 10 years since our last contraction. And based on economic data without COVID-19, it's hard to say if we would have even seen one then or not. Some even argue that by definition, we saw a recession again in 2022, which certainly would not match the typical cycle. But I don't want to get too in the weeds of that right now. Next week, our entire economic discussion will be focused on economic recessions. What's real, what's exaggerated, and what you can do to prepare. Misreading these economic phases can lead to misjudging the risk behind them. If you interpret a slowdown as collapse, you'll overreact. If you interpret late cycle excess as permanent growth, you'll underprepare. So understanding where we are in the cycle doesn't require perfect prediction. It requires recognizing patterns in things like employment trends, credit conditions, inflation direction, consumer confidence, and corporate earnings. All of these signals combined matter more than any one single data point. This is why context changes how volatility feels. If you understand that a sector is adjusting within a broader expansion, volatility feels different. You don't have to be scared, but you can be prepared. And this really brings us full circle from our market discussion. Gold often gains attention when people believe contraction is imminent. But if we're simply transitioning between phases, the reaction may not match the data. That perspective allows you to interpret volatility much more accurately. Every financial decision you make is a trade-off. We don't always think about it that way, but it is. Every time you spend money, you're choosing one future over another. And that's not just me being dramatic, that's simple math. This week, as we continue our discussion on cash flow strategies, I want you to think more intentionally about your financial trade-offs. Do I want this more than I want that? That's the only question that really matters. Do I want this $30 Amazon purchase more than I want to buy a house? Do I want this upgrade more than I want financial flexibility? Do I want this convenience more than I want progress? Now, if the honest answer is yes, I support you. But most of the time, the answer is no. Low value spending competes with high value goals. Not in one dramatic moment, but slowly over time. It's not usually the planned big purchases that delay progress. It's the small, repeated ones that never feel significant on their own. Trade-offs compound just like investments do. Intentional spending is powerful. It isn't about restriction, it's about clarity. When you evaluate spending through the lens of more than or less than, decisions become easier. And I'm not trying to eliminate your joy, I'm just trying to help you prioritize your outcomes. Going back to our discussion on economic cycles, context can make trade-offs more obvious. If we're late in a cycle, you might prioritize liquidity. If we're early in expansion, you might feel more comfortable taking on risks. Whether you've realized this or not, your personal decisions don't exist outside the economy. They exist within it, which is why awareness matters. You might be tired of hearing me say this by now, but structure beats impulse every time. When you understand your goals, your plans, and the environment you're operating in, you can make decisions intentionally because your path is clear. After today's discussion, you should have a better understanding of why gold gains attention when uncertainty rises, and why owning something different is not the same as eliminating risk. We walked through the economic cycle and why, despite what news or social media influencers suggest, those phases don't always move neatly from one to the next. And then we brought it all back to your daily decisions, recognizing that every dollar you spend competes with the future you say you want. Markets are going to adjust, economies are going to transition, and cycles turn. Your job isn't to predict every shift perfectly. It's to understand the environment well enough that your decisions remain steady inside of it. Next week, we're going deeper into one phase in particular, recession. We'll discuss what truly defines it and what you can do realistically to prepare for it. For updates each week, you can subscribe here to my channel or follow the link in the description to subscribe to our weekly newsletter. I hope this offered some useful perspective, so until next week, take care.